The accounting cycle. The accounting cycle involves the collecting, processing, and reporting of financial information. The main steps include the following. Number one, you prepare your journal entries, then you post to the journal entries to the ledger, and then prepare a trial balance before adjustment. So this is basically your initial step and your trial balance. The next step, step 4, you prepare adjusting journal entries, post adjusting entries to the ledger, and then an adjusted trial balance. From there, you prepare closing entries, post closing entries to the ledger, and then prepare an after closing trial balance. And finally, you prepare your financial statements. It looks like a lot of steps here, but it's not. It's only 3 major steps and the last one, preparing your financial statements. Let's go ahead and go over the first step. If you recall from the previous tutorials that have been posted, we're going to use the same examples, and what we're going to do here is we're going to fill in the journal entries for these instead of using the basic accounting model where assets equals liabilities plus owner's equity. We're going to incorporate some more details here in terms of the actual accounting process. So here on September 1st, Jane organized the company Academic Lawn Services and invested cash of $200 in the business. So on September 1st, she's put $200 into the cash, or $200 cash into the company Academic Lawn Services. And if you recall the basic accounting model, assets equal cash of $200, therefore owner's equity must be $200 in capital. Here on September 15th, Academic Lawn Services borrowed $1,000 from Bank of University. So the company now has $1,000 in cash and a new notes payable of $1,000 to the Bank of University. On October 1st, the company purchased landscape equipment for $1,000. So they used cash of $1,000, and now they have equipment worth $1,000. Two things happened on October 1st. The company also purchased $10 in gas. So here we have gas supplies, $10, and then cash, a credit of cash, $10. On October 15th, the company provided services for its first client and billed and collected $30. Okay, it collected the $30, so therefore it has cash of $30, and it did its work, and now it's $30. Revenues of $30. October 17th, the company provided services for a large client and billed them $100. They did not collect the cash. So we're not going to have cash of $100 here, but instead we're going to have accounts receivable of $100 and revenues of $100 because of accrual accounting that was earned. We're going to go ahead and stop here at October 17th for our trial balance here. So let's go back here. What we did was we just prepared our journal entries. Now we're going to post our journal entries to the ledger. What we're simply going to do is we're going to take our journal entries that we took. So the first one was on (9/1) here. So on 9/1 we have a cash T account. Here's our ledger. On 9/1 we have cash of $200, and then we have capital here on 9/1 of $200. On 9/15 we have cash of $1,000 and notes payable of $1,000. So on 9/15 we have cash of $1,000. Okay, and we have a new notes payable account of $1,000. This is our ledgers. On 10/1 we have equipment of $1,000 and cash of $1,000. So here on 10/1 we used up cash of $1,000, and now we have a new equipment account of $1,000 on 10/1. We also on 10/1 got gas supplies and cash. We used up $10 in cash, so it's a credit, and we have a new T account here. Since it's a supply, it's an asset, $10. Here on 10/15 we start earning some money. So here on 10/15 we get cash of $30. It'll be a debit, and then we can create a revenue account. Just throw it up here on 10/15, revenue of $30. And then on 17 of October we have revenues of $100. Revenue of $100, and we have a new account, a new ledger. On 10/17 we have $100 and accounts receivable. Okay, so this is our trial ledger. Now we're going to do, if we look back here at our steps, now what we're going to do is we're going to prepare a trial balance before adjustment. A trial balance before adjustment. All we need to do here is take each of these accounts and right now AR has what? A debit balance of 100, revenues 130, cash what? 200, 190, 220, capital 200. So all we need to do now is prepare a trial balance sheet. And let's go ahead and use technology here. We can take cash, AR, equipment, and gas supplies. And then let's go ahead and do notes payable, revenues, and capital. Let's start up a debit balance and a credit balance. So our cash was 220. AR was 100 from over here. Equipment was 1,000 debit balance. Gas supplies was $10 debit balance. Notes payable was 1,000 credit balance. Revenues 130 credit balance, and capital 200 balance. So there we go. Equipment should be $1,000 balance. And there we go. As you can see, a trial balance does help you find some mistakes, some errors that you made in posting to the ledger. And here, posting to the ledger was correct. It was just taking the information from the ledger to the actual trial balance, in which there was an issue. But here it does balance up, and seeing that it does balance up finishes the very first process of the accounting cycle, which is the initial trial balance, where we prepared our journal entries, posted general entries to the ledger, and prepared a trial balance before adjustment.